subscribe now and press the bell icon. Never miss an update.
Let's go over this quickly. Today will be a very short class. We'll just finish up these two small topics. Let's see capital gains on sales of stock. So, any gains and losses from the disposition are generally determined tax like gains and losses from the disposition of other property. Okay, so there's nothing new about it. We know this thing. It's just good to read it again and get it refreshed. But the treatment will be like of any other property that you're selling off. Return of capital. Return of capital, it reduces basis. We have also gone through this example that if we have put in some capital, say in a partnership or anywhere in the company, say we have put in $50,000 and the company is giving us back that money saying it's return of capital, then it is not taxable. Because maybe they gave $10,000 back. So 50,000 basis gets reduced to 40,000. But that's not income. Once the basis reaches zero, and still if they are giving some distributions, then that's extra. That is much more than what we have put in. That's our capital. So obviously this would come up as taxable income. Undistributed gains, undistributed capital gains earned in a mutual fund are taxed as capital gain in the current period. So it's undistributed, fine, but it is realized. Maybe it's realized gains. Maybe it's just sitting there, right? A lot of times we tell or we do our when the transaction is happening automatically, or when we have a FD, we put that checkbox that renew it automatically. That means we are not taking out the money, but it is still a gain. FD income has to be put up for taxes. The same thing. And when here we are talking about mutual funds, we are talking about only US mutual funds. Don't get it confused with any foreign mutual funds or 8621 filing or mark to market and all. Don't worry about this part right now. Okay. 60-40 rule. This is important. 60-40 rule. What does that say? Again, this is not a very usual scenario. We don't see a lot of people dealing in a future contract, foreign currency contract, options and all. But a lot of times for the traders or people, those who are into stock market on regular basis, they may be doing. It's not, in fact, it's not even uncommon. So we will get those statements where they're buying and selling contracts, future contracts, foreign currency contracts. That means it's not like something that they're buying and keeping it with themselves and later on selling it. They're just doing a future transaction that in future I'm going to sell this much at this much price, right? Or they will take an option that if the price goes to that level, I'm going to buy the stock, and I have bought that option. That means I have a right to buy that stock. So automatically, because we have option, we will buy it and not. I mean, all these transactions, they're very common in stock market, and people, those who have knowledge into that, they'll probably do it. So what IRS says, let's read this thing. Generally, positions in regulated future contracts, foreign currency contracts, non-equity options, and dealer equity options in an exchange using the mark-to-market system are treated as if they were sold on the last day of the year. This is what we do. This is what mark to market means. When we do mark to market calculation, we always assume as if they were sold on last day of the year. And we have to see what is the change in the value of those assets from the beginning of the year, or from the time they bought it, if this is during the year, to the end of the year. And that is called mark to market. So what IRS has just simplified it. They're saying if this is what you're dealing into, future contract and non-equity options and all those things on an exchange. Okay, this must be happening on some stock exchange. It could be New York Stock Exchange, NASDAQ, National Stock Exchange, something else, Bombay Stock Exchange, whatever. So, any capital gains or losses arising under this rule are treated as if they were 60% long term and 40% short term without regard to the holding period. This is a 60-40 rule. We don't have to present anything or prove it that this is going to be, maybe it's 100% short term, but we have an advantage if we go with 60-40 rule. Or maybe it's an 100% long term. There we are in a disadvantageous position because we still have to put 40% as short term. It's never, actually, like practically speaking, it's never 100% long term, because usually like they take these positions for 2 3 months and all, futures and equity positions and all. So, but to simplify it, what IRS is saying is just go with 60-40 rule, take 60% long term, 40% short term. And actually, there's, especially if you're dealing it on US markets, whichever brokerage firm we are going through, they would do a proper compilation of all these transactions and give us a 1099 that we can take comfortably and put that up for taxes. We don't have to go and to each and every transaction and start like calculating what is 60%, what is 40%, and all. But if this transaction is happening on some other stock exchange where a 1099 is not being issued, then at least we know the rules, that how do we do it, how do we collate it, how do we summarize all these transactions. Then we can go with 60-40 rule. Okay, any questions here? We can go to the next topic,
So
otherwise,
I
yeah.
have I have a question. In our
Yes.
it's 8621 form, no?
Yes.
So in our working, we don't mention any long term or short term. So software automatically takes it as 60/40.
No. 8621 is different. That's why I'm saying when we are talking about mutual funds here, this is all US mutual funds. We are not talking
Okay.
about foreign mutual funds.
Okay.
These are all US mutual funds. 8621 comes into the picture when there are foreign mutual funds.
Oh, okay, got it.
And that's a complete different transaction. Everything there is short term only. That's why
Right.
they say it's not like, I mean, this is the most, it's detrimental to taxpayers' interest, the way they have designed 8621.
Yeah,
Everything
I
goes for mark to market, or it goes for short term, even if like the whole calculation is not very tax friendly. So that's
got
why
it.
we tell our clients that, to the extent possible, if they don't take the exposure in foreign mutual funds, is better for them. But the fact is that people would still want to go and put money into mutual funds. First, they are safe, the volatility is not that bad, risk management is better, and they have been giving good rates last few years. So they're like, okay, if I'm making 14, 13, 14%, and even if I have to pay taxes, then my effective is what, 10%. That is still better than what I would get in other markets. Maybe other places and getting only 6, 7%. In that case, then we can tell our clients that fine, go ahead with that. If your math is working out that well, that okay, if you spend money if you invest money into foreign mutual funds, at the end of the day, you're still better off than putting money in some other investment scheme. It's good, but then let's also look into the tax cost and factor that in as well. Even after factoring that in, if it is giving you some benefits, then fine, go ahead with that. The reporting is going to be a bit complicated. Your tax return may look very bulky because there's a lot of, every fund has to be disclosed. But again, that doesn't stop people from investing. It's just that there are more compliances. And but that is fine. Sorry. So let's look into the last section of this chapter here, section 1202 and 1244 stock. Does anyone remember what is 1202? We have gone through that before. Anyone?
Qualified business stocks.
Yes, qualified small business stock. QSBS.
USBS, yes.
QSBS. Okay, that's again very important because a lot of our startups take benefit of that, or at least they plan their exit in a way that they should get 1202 benefits. So how this is how like popular it is. This is how practical it is. It is not like something where this is just put up there and people hardly take advantage of that. 1202 is a very very important section, and that is something which has really boosted startup industry in US. Because imagine $10 million of gains, up to $10 million, it's a very big number, and completely waived off from US taxes, federal taxes rather. State will have their own rules, so let's not talk about state right now. We'll just focus on federal. But that itself is a big saving. Okay, let's see 50% exclusion, meaning 50% of the income will be excluded from taxes. There are certain dates mentioned here. We have to see when the company was incorporated. If it's incorporated after so and so, held for more than 5 years, they may get 50% exclusion. Between 9 and 10, the exclusion increases to 75%. And after September 27, 2010, if they have incorporated the company, which majority of our startup clients, they have their company incorporated after 2010, the exclusion may increase up to 100%. Okay, and but there are some limits and all we have to see. There are obviously, I mean, there is a definition what is considered to be QSBS, why what is considered to be small business, what conditions should they have to make sure they're still falling under the small business category and all. So what they're saying, it has to be a domestic C corporation. It cannot be, you cannot have this gain in a foreign company and then you say that, well, everything else I've satisfied. It's a company, I've been holding stocks, it's less than $50 million. I'm the original shareholder. So I should get benefit. No, US is saying this is only for domestic companies. We don't care about foreign companies. And the gross assets of the company should not exceed 50 million. They're talking about gross assets, not net assets. So you are not going to deduct liabilities out of it. We're just talking about gross assets. It should not exceed 50 million. If the company has raised 100 million and all, they will not fall into QSBS anymore because their asset is quite big. They've crossed that $50 million threshold. 80% of its assets should be used in the active conduct of a qualified business. It's not like, they have this $50 million sitting and out of that, like 40 million, they're just putting into some mutual funds and all, and they're just getting, returns out of it. There has to be, those assets should be used for an active qualified business purpose. That means if you're a software company, use that money to develop the software, not put it into the bank or not put it into mutual funds and just, reap the returns out of it and just sit, and saying that, oh yeah, this is QSBS. It should not be like an investment company. It has to be there has to be a proper purpose, and that there should be a qualified business that they must be taking care of, and the assets should be used for that business. Then only it makes sense to give this break to startups because they are the one who are taking risk. What is the risk that you're taking if you put all the money into FD and just sit there and saying that, yeah, fine, I want to take advantage of small business and all this. Any kind of business can be considered as a qualified business. It could be personal services, farming, extractive, whatever. There's a lot of list here. Sorry, they're saying other than that, it could be considered. Yeah, so majority of that will be software, startups, tech, R&D, defense, education, finance companies, and all. A lot of those will fall under qualified business. But other than they're saying these companies we will not take as qualified business. Any of the personal services, because again, the risk factor is not very high here. Okay, that's we have also looked into this QBI income, when we were reading about QBI, right? What is a specified business? What is non-specified business? Or SSTB and all. Do you remember that? So they have specifically excluded all these personal services business. Annual gain limit, it could be up to $10 million or 10 times the adjusted tax basis, whichever is higher. So we have to take, if we are selling of certain stock, if the basis of that is $5,000, 10 times of that will only come 50,000. So we have to go with the greater of 10 million or 50,000, whatever that is. So the greater will still be 10 million. But if it's 50,000 and times and all, if it comes to 50 million, whatever, then your gains are limited to 10 million. The waiver is limited to 10 million. Up to $10 million, there will be no taxes. After that, they have to pay. And we have seen this thing, the 28% rate, capital gain rate is applicable. Remember yesterday or day before when we were going over the capital gain rates, that it could go from 0% to 28%. That's where we saw that section 1202 gains will be taxed at 28%. Because after giving exclusions and all, whatever is remaining, that gets taxed at the highest possible rate. AMT also, when we were looking into AMT, alternative minimum taxes, we knew that up to 7% of the gains will come up for minimum tax calculation. So, yes, so well, people may say that 1202, it gives complete gain benefits or complete exclusion and all, but we still need to see what will be the AMT impact. The good part is that AMT can be carried over as MTC, minimum tax credit, and in later years you can use it, but still the AMT will be applicable. It's not like you'll be completely like it is no liability at all. And we have seen all this thing in AMT chapters. Gain rollover, individuals, yeah, so there is gain rollover. So whatever gain is left over, if we again reinvest it into same kind of stock within certain time, then we can be eligible to claim an exclusion on it. And this is also, we have seen that a lot of those capital gain schemes are there, right? That we take the money and again put it in certain bonds or certain kind of investments which are approved by the government in order to get the waiver. So same thing, you're saying that there are certain conditions here, but what we need to remember is there's something called gain rollover. If we are rolling over that amount into another QSBS stock, it has to be purchased within 60 days after the date of sale. Then you can avoid gain even on that amount which is on which you're not getting 1202 benefit. So there are certain conditions for that also, that within 60 days it needs to be bought. And the small business stock that we are selling, okay, when we sell something, then only we'll have gain and we'll look into rollover. So whatever we are selling, it should be held for at least 6 months. 6 month and 60-day period and all, we need to be careful about that. Within 60 days, they have to make a new investment in order to qualify for gain rollover. And there could be QSBS stock can be held through pass-through entities. That's also possible. Pass-through entities meaning LLC or partnership. A lot of times people are not holding the stock directly. It's not like the person individual will be the shareholder. The person may say, well, I'm going to make an LLC and all my stock holdings are going to go through LLC. But those are pass-through entities, so those are also considered for this rollover. The pass-through entity will have to make the election, and there's a process on how to get the waiver and all these things. So they have to make an election if the entity sells stock held for more than 6 months, and if they are replacing that and they're like buying another QSBS stock during the 60-day period. Okay. And so that benefit can go to the the holders of that LLC. This is what they're saying here, that individual who has held an interest in the entity and who purchases stock may take the rollover election with respect to individual share of any gain on the sale that the entity does not differ under section 1045. 1045 is the rollover section. So what they're saying is, if the LLC is not taking that, then individual can also like go ahead and take the advantage of that section. But 60 days is a very small window, so this planning needs to be done quite ahead of time. If somebody is getting a gain of $1 million and suddenly we say that okay, within 60 days you need to invest it again, it's very small window that they have given. It may not be possible. So all these things we need to first let the client know ahead of time so that they can figure out something what they need to invest in and all, and within 60 days they close their new investment. Okay, section 1244 also, like, this could be a bit confusing and all. What we'll do is we'll just touch base on it a little bit. We'll not like too much dive into it. So what they're saying is, an individual may deduct as an ordinary loss. This is again an important. Deducting something as an ordinary loss gives more tax benefit than taking something as capital losses from the sale or exchange of small business stock. Okay, issued by QSBS, qualifying small business corporation. So we can take advantage of that as an ordinary loss. There are certain conditions for it, that the shareholder must be the original owner of the stock. They should not take that stock in the secondary sale. They should be the first owner of the stock. Maximum amount that you can deduct is $100,000. A corporation qualifies if the amount of money any the property it receives, it does not exceed 1 million. So this is again not a, like, your total contribution to capital should be less than 1 million. And if the taxpayer makes capital investment in the corporation without receiving stocks and all, so if there is the taxpayer is making some investment but there's no stock which is being issued, but still it's a capital investment, then the loss must be allocated between the investment where stock was received and investment where stock was not received. Sometimes they will put the investment as in the form of debt or convertible debt. To some point of time, it may be converted into equity, but stocks have not been issued. Maybe in the future, maybe the idea was that it could be any point of time, it could be converted into equity. That's why they call it convertible debt. So what they're saying is, in order to take section 1244 benefit that we can take when we are writing off those small business stock, if there is a loss there, we are writing that off. And if you want to take as an ordinary loss, what they're saying is there has to be stocks issued for that. So losses from investment without receiving stocks are not eligible for section 1244. There has to be some underlying investment there. And the loss has to be allocated between investment where a stock was received and where stock was not received. So if the loss is like $100,000, we have to see how much is applicable for convertible debts and how much is applicable for the, say, preference shares, if the person is holding that. And on preference share, say the ratio comes to say 30,000 of the loss will go for preference share, then only on that you get section 1244 benefit. It also needs to be reported on form 4797. Okay, with this we have closed on on all these capital gains and stocks, basis adjustments. Any questions here? Any doubts? Does everybody know now what is 1202 stock? What is 1244 stock?
I have one question.
Mm-hmm.
So I understand that this limits to the sale and the gross asset, the section 1202. But is there any limitation of how much of the business is outsourced? Because a lot of companies actually land up doing sales in US, but the expenses are kind of outsourced, right? Like back office and the operations, everything is done from another location.
Yeah, that's a very good question because most of the startups have this model. Like most
Mm-hmm.
of not just the startups, even established companies, even like companies like Microsoft and Amazon and all, which no more fall into any startup category, they'll also have like their back office centers in places like India or Mexico or somewhere else and all. That should not matter because what they are saying is the company has to be a domestic C corp. It has to be a C corp only. A lot of people will form a LLC and they say, can we get QSBS uh, advantage for the LLC? That's not possible. It has to be a C corp, and it has to be domestic C corp. It doesn't matter then you're doing the outsourcing or not and all. That's still okay. They're not talking anything about the expenses part here. In fact, even revenues can come from outside US. That doesn't matter. Expenses can also be paid to people outside US. See, that matters when we are calculating R&D credits, research and development, because there the intention of the IRS is to make sure whatever research and development activity is happening in US, they give a benefit only on that. But if you have outsourced all research to some other center, then I mean outside US, then we cannot claim that for R&D credits. But there are some other states which where the laws are in conformity with federal laws. So
Okay.
they may agree with federal law of QSBS waiver and all, but I mean it all depends on the state to state. California does not, New Jersey does not, so they have to pay. We just did one client QSBS calculation for New Jersey. We asked them to pay like whatever, like some $150,000 in taxes because there was no benefit coming in New Jersey state. So that's where US taxes get bit complicated because federal is one part of it. We always have to see what the state is saying. Unless you are staying in like Texas or Florida or Washington where there is no tax at all. Yeah, those are really nice places to stay. But California, New York, New Jersey, they're the most expensive states when it comes to taxes. So they are the states where they need a lot of tax planning to be done. And how do we get the waiver, or is there a rollover option for a state, like if we reinvest that money, can we take a break and all those things? And it's not very easy to get away from the requirement of those states. It's not like a lot of people come and say, well, after 3 months I'm expecting a big gain. What I'll do is I'll pack my bags from California, I'll go and move to Texas. Yeah, then I can avoid that, right? It doesn't work that way. California is very smart state. They'll go back in the last 2 3 years and see what you've been doing. So it's not that easy to get away from the requirement, but yes, with proper planning, with some time on hand, it takes like 1 2 years. We have a proper plan, and there has to be a reasonable reason why you're moving out of California. If we say that we are just moving out because of the tax reasons, then that may not be accepted. So people have to make a story around that, although the reason may be just tax reason. But again, it all depends on what kind of planning we can do, how can we save ourselves. Okay, all right, then we'll close it here.